Hi, everyone. Thank you for the presentation. Appreciate the time. My question is, you mentioned Ray Dalio several times during the presentation, and Ray mentioned before that, if you don't have gold in your portfolio, you clearly don't understand history. And I'd be just curious to learn a little bit more about, I noticed under the alternatives section, there was a focus on hedge funds and some private equity. But I'd be curious to learn a little bit more about your opinions on how you approach investing in commodity markets to gain more exposure to that.
So we also have a precious metals fund, and it's about, I'm going to say 30% in gold, financial gold, so ETFs, and about 70% with gold stocks. We use an external manager, RBC, to manage our gold stocks. And we think gold plays a role in the portfolio. We view it as a form of currency and a safe haven. And the way we look at gold is the correlation to real interest rates. So gold does well when real rates go negative, as the fiat currencies are starting to be debased. And we think that gold provides you protection in that kind of environment. So we do think, we're not 100% in agreement on all the time on gold, but we do think you should have an allocation of gold, and we would agree with Ray Dalio.
So this is the 100% not agreeing with him. So a few years ago, I did a study. There's a guy named Homer Sidney that wrote a book on the history of interest rates, and it's really dull reading. Goes back to Persian times and what they were charging in 4000 BC for loans between merchants and farmers and things like that. But they take a look at interest rates all over the world with a lot of detail over the 20th century. Now, the important thing to remember is these are interest rates on sovereign bonds. This is government paper, basically. And the argument for gold is that gold is an inflation hedge, and it will protect you better than paper money, fiat money, and especially true when there's relatively high inflation. Now, by any reasonable measurement, the 20th century was the most inflationist century in human history. Prices went up by a factor of well over 20 in the 100 years. So in 1900, if you bought an ounce of gold, actually we used 1914 to 2014 at the time, so that 100-year period of time, gold was $20 an ounce, and in 2014 it was, let's say, 14 or 1500 US, call it 2,000 Canadian. So clearly it easily multiplied by more than 20. It only had to be worth roughly $400 to $500 to have met inflation. So it did that. It did what it was supposed to do. But if I'd taken the same $20 and bought just $20 of Government of Canada bonds and just reinvested the interest for the entire 100 years, I'd have almost $5,000 today, 100 years later, more than 2.5 times what the gold is worth. So the argument that I looked at is to say, well, if gold can't beat government bonds in the most inflationary century in history, in the long run, when is it going to? So I get the idea of gold when there's blood running in the streets and basically foreign armies are taking over and you have no other way to trade or barter and things like that. I understand that. But I do struggle with the idea that on any particular capital, I'm not actually being a yield. It's a bit like saying, I'm going to invest in Swiss francs, which has been a decent investment for the last 40 years, as long as you don't mind not being paid interest. So I think that there are two sides to this discussion. It's not a slam dunk that paper money cannot equal gold, because it's been able to prove that it can.
So here's the rebuttal to the rebuttal. There are other hard assets one can buy to protect their purchasing power. I think real estate is one of those. I think quality corporate quality equities are another way of protecting purchasing power. If you look at the world right now and the amount of debt that's been accumulated, the only way you're going to get out of that debt and reduce that debt, because you're not going to grow yourself out of it, it's either you default on it, and we just said before, you don't default if you issue debt in your own currency, or you inflate your way out of it. And that's the whole idea with this modern monetary policy. It's not modern. It's happened every single time in history. That is going to eventually be what happens. It's one of the reasons why central banks like inflation, because slowly they're eroding away your purchasing power. Gold is a way to protect that in a liquid form. So again, in a diversified portfolio, would I put all my assets in gold? No. Would I have some in gold? Yes.
So I'll let Tigger have the last word on that one.